Good morning. Welcome to our presentation. I'm Heather Kelly with the Illinois SBDC at Rockford Chamber. The SBDC offers no cost business consulting and guidance to local small businesses in the areas of marketing, business planning, accounting, and human resources. So if you need to contact us, I will provide that information in the chat. We would love to sit down and help you with your business. And please be sure to follow us on social media, on Twitter, Facebook, Instagram, and LinkedIn. The handle is Rockford SBDC. And today, I am happy to introduce our guest. Eric Magnuson is the Vice President of Commercial Lending for Illinois Bank and Trust. Eric, thank you so much for being with us. Eric will go through his presentation, and then we'll have a Q&A after for those of you that would like more information. So with that, I'll let Eric take over.
Excellent. Thank you very much, Heather. So excited to talk to everybody here. The topic is commercial lending, kind of with a focus on small business finance. So a little bit of my background. I've been a commercial banker here in Rockford for about 12 years and with Illinois Bank for the last 3. And so kind of get into it here. The overview is how you prepare yourself for commercial banking and what banks are looking for. So this is kind of just an overview of the agenda that we'll go over, that kind of goes over steps of getting ready, your loan package that you need to prepare, financial statements, types of financing, how you qualify, loan options, and then questions you should be thinking about when you're talking to a bank. So we'll just kick it right off. So the 5 C's of credit that banks are looking for, and I'll go through these kind of one by one. And if anybody has questions, feel free to stop me. But capacity is the first one. So the lender wants to know how you intend to repay the loan. So if you think about it, there's lots of different types of businesses out there. So if investment real estate's a popular one, where people own an investment property and the rents are going to repay the loan. Say you have a CNC shop, your cash flows for selling whatever you're making is repaying the loan. So the bank wants to see how profitable the business is going to be. And so we'll get into business plans as well, but that's kind of your capacity. Capital, how much you personally are going to invest in the business. So again, every business is a little bit different in how you do that. Maybe buying the equipment up front, maybe investing in some of the education that you need, training, hiring people, or buying actual fixed assets. Collateral, and so that's how the bank's going to be secured. So real estate's an easy one, but there's lots of different forms of collateral. At the end, we'll kind of talk about some SBA differences as well. Conditions. And so that's just the intended purpose of the loan. And then this gets also into economic conditions too, which is really important in today's day and age. Banks are looking for you to be able to speak to any COVID difficulties. And that varies from industry to industry. So, supply chain delays is a very common one, and the bank will look to you to kind of be able to speak of how long that delay is, what kind of difficulties it'll cause for your business, and how you're getting around it to lessen the negative impact. Workforce shortages kind of falls in there as well. Is it difficult to find people? How many people do you need to run your everyday, day-to-day? And just future plans. So conditions is an important one, especially when you're building out kind of your business plan. Character is, a little bit tougher to convey when you're starting a loan application or a relationship with a bank. But a lot of that initially will kind of come from credit score of how you've repaid back previous debts. We'll get into more credit score stuff later in the presentation. So how to get ready. So have a business plan. So no matter what the business that you're either starting or have is, when you go to a bank, they want to see that a business plan is made, and that it includes, sorry, just 1 second, that it includes your kind of projections, profitability, and that it's realistic. So you kind of know what you can afford, you know how to read the financial statements and kind of what they're conveying. You should definitely check the credit report before you apply, just to kind of see what's out there if you don't already know what's on your credit report. There's lots of free options online to be able to do that, to monitor nowadays. Establish collateral options. So be thinking about what you could pledge as far as collateral options for your loan. And then show your equity contribution to be able to show, so if it's a real estate purchase, it's relatively easy to show, so say it's 100,000, you're putting 20,000 down, that's an easy calculation. But if you purchased equipment and trained people and done all kinds of, every business is different, then you want to be able to show that as well, because that's your kind of skin in the game. And the banks like to see that they're not the only one putting money into the new business, that you're also investing. And so it's nice to be able to show the things that you've done to build your business to the point of where it is. And then just researching finance options. There's lots of different finance options, and we'll kind of get into that here. Common elements of a loan package. So business plan, like I already mentioned, financial statements, so current and historical. So, banks are usually looking for, 30 days ago is probably fine, or at least the previous quarter. And then historical 2 to 3 years, depending on how much you're applying for. Personal financial statements, which is just a listing of any assets and debts that you have. Business personal tax returns is self-explanatory. Source of your equity contribution, so the equity that you're contributing to the business, where's it coming from? Credit report. So credit report, we can talk about that a little bit. It's very important, especially for small business lending, to have a positive credit score. The top 3 things that go into that, first is just your repayment history. So past dues are going to be the quickest thing to knock down a credit score, and really takes about 2 years for that to roll off. It'd still be on there, but after 2 years, it's a much lower effect. And the further you get away from those missed payments, the better your credit score will improve. If there's any collections or things like that, the bank will want to see those cleaned up. And then credit usage is very important. So the percentage of used credit line in totality that you're using. So say you have cards and loans available of 50,000. If you're using more than 50%, that's going to negatively affect your credit report or credit score. Banks really like to see it under 25. And then the third most is your length of history. So banks like to see a positive history of keeping accounts open and used, and not just opening and closing and jumping from account to account. So that, it's the third most important. It's not the biggest thing, but it definitely goes into the credit score. Collateral, we've already kind of covered. And then so purchase agreement, appraisals, contracts, estimates. So a purchase agreement would obviously be required, before you get approved for a loan. You can seek kind of a pre-approval or like a letter of intent. So in commercial and small business banking, it's not the same as buying a house. So a house, you get kind of like what's called a pre-approval. In the business world, it's more of a letter of intent. And so it's dependent on formal underwriting. And so this is common with all banks, is they'll look at kind of all of the other things leading up to it, but there may be some missing pieces that they need to finish the underwriting. And they can give you a letter of intent to finance, and then you can proceed that way. Appraisals usually are not ordered until you have the purchase agreement, because there's cost incurred there. So moving on. Financial statements. So there's three basic statements. So you have your balance sheet, which is just a listing of assets and liabilities in a specific time period. And then you have your cash flow projections. This is important. So banks like to see, depending on the size of the request, 1 to 3 years of projections for a business purchase or a startup. So meaning something that hasn't been, so if you've been in business for 2 or 3 years and you have the historicals and you're not planning on big changes, then the projections won't be as important. But if you're acquiring a new business, it's going to be new management. They want to know how you're going to manage it and how you're projecting to grow. And they want that to be kind of realistic. And then, if there's different jumps in revenue, they want that to be explained. So how are you going to get from A to B? Say, the business is at 250,000 annual revenue, and in your projections, you're showing year one at 400. Well, just an explanation of why that could be adding a new product or service or whatever it might be. Profit and loss statement, P&L or income statement is just a listing of income and expenses. Again, actually, let's see. I will have an example, so I'll get back to the income statement. This is a balance sheet. It's very simple. It just shows your assets and your liabilities. So owner's equity is going to be anything that you've injected. It shows equipment values, cash values, inventory. Accounts receivable is another asset that would be listed if your business is a business that has accounts receivable. So this is just the kind of cash flow can be defined a few different ways. What's important for how a bank looks at it is the bank's going to look at net income, and then they're going to add back any non-cash expenses, kind of like depreciation. And then they're going to divide that by what your debt service is. So say you're taking out a loan for a few $100,000 and it's a 5-year loan to buy some equipment. You figure out what your annual payments are, and then you're going to divide that by your net income. And so that's one of the most important metrics that banks are looking at to see if you can service the debt. That's just an important one to be aware of. So here's just an example of just a basic projection. So it goes month by month, and it shows your cash balances and how they're moving. Sales, shows expenses, and you can pick up trends. And so, it could be seasonality trends, it could be growth trends, and then you have the explanations off to the side on that. Just because on the projections, it's something that hasn't happened yet, and the bank wants to know kind of how you're going to get from A to B, and then anything in there that's kind of fluctuating, the reasons why. And usually it doesn't have to be paragraphs upon paragraphs. It's really just brief explanations there that the banks are looking for, just so they understand it. P&L. So this is really just the same idea of what we just went over, is that you're doing a calculation of your sales. You got your cost of goods sold, which is your costs. And then you have operating expenses, overhead, and then you get to your net profit. And that's what the bank is using to figure out what your business can debt service. The last thing the bank wants to do is get you in a bad position where we've lent too much and the business can't service it, because it just puts it in a lose-lose situation now. So types of financing, there's lots of different types of financing. The very basic would be kind of your longer term real estate, which in commercial world, you usually go out to 25 years as an amortization, and they do a 5-year fixed. And so your rate is locked in for 5 years, but your payments are based on 25. So there is some interest rate risk there to be aware of. When the loan rate resets after 5 years, then you will have obviously a slightly different payment if rates have gone up or down. So that's longer term financing. Then you get into equipment finance, which equipment finance is usually industry-wide, it's pretty basic at a 5-year. So 60 months to pay and a fixed rate. The reason, so if you have a longer use of a life for the equipment, so say it's equipment that'll be used for 20 years, some banks are willing to do a longer term finance on that. The idea on the term needs to match the useful life for when you're going to be replacing the equipment. And so that's kind of the idea behind the structure. And then the next one would be a line of credit. Line of credit is short-term finance, and that's described as a 1 year or less. And so banks do like to see that revolving up and down. And so use it to buy inventory, pay it back down after money comes in, and it revolves back and forth like that. If the bank is being proactive in kind of monitoring a line, and they see that it's usually over 75% used and it kind of stays there, they may reach out and talk to you about terming a portion of it out, which isn't a bad thing. And so it's basically saying that they're noticing that the line is being used a little bit more like long-term debt. And what you can do is you can term it out, and as long as you have enough collateral, you can term that out, have your payments being made for that, and then free up the line for what it's supposed to be used for. On there, it also notes personal lines of credit. So personal lines of credit really isn't, I don't advise using it that way for a business, but there's all different kinds of ways that you get your seed money to start the business. And if that comes from a personal line, banks are fine with that, but they're going to also take that into consideration that there's some debt service from the seed money. So that's just something to take into consideration. So criteria for qualifying for a loan. So in the small business world, kind of defined as companies with revenue 5 million or lower and lending needs of $1 million or lower, credit score becomes very important. So it may be a company that is newer, and especially in that situation, there's not as much historical data to be able to go on. So the bank's going to look to see what the credit score is, and it's just a personal credit score, looking to see how previous accounts were handled, repaid, and there's really no magic number, but over 700 usually is looked positively on. Equity contribution, we've already kind of went over. Ability to repay, very important. I mean, that's really just looking at those cash flows and trends. And so trends are another important one. So if you're acquiring a business that's on a downward trend over the last 2 years, it's reduced in revenue or net income, either one, then you want to be able to show in your projections and your business plan how you plan to turn that around, because the bank will definitely be looking at that. Loan to value ratio. So that really applies to fixed assets the most. So like real estate, banks usually will go to 80% on a real estate purchase, especially if it's owner occupied. 75 is a little bit more common for investment real estate, although it just kind of depends on the overall situation. If it's cash flowing very well and there's a strong guarantor, then the bank may go a little higher there. So it's very situational. And this kind of goes to different loan options. There's lots of different ways that you can set things up. The SBA is a great resource for startups and acquisitions because the bank gets a guarantee from the SBA. And so if the loan defaults, the bank has a guarantee there. So it's not really a form of collateral, but it's kind of a form of repayment for the bank. And so they're able to do some deals that maybe they would be a little bit too exposed conventionally. And there's fees involved with the SBA, and they may ask, so if you have a uncollateralized loan, they may ask that you pledge a house if you own your home, and there's equity in it for an uncollateralized loan. So they do try and cover themselves, but it is a way to do an uncollateralized loan if there's no other options. So for startups especially, and like I said, acquisitions, you're going to have an uncollateralized portion, and that's a good option to look at. Questions asked the bank. So loan fees, those are usually pretty uniform across the industry. There's not huge differences until you get into large commercial, which, if you have a lot of complexity with the deal, the bank's going to spend a lot more time and charge a higher fee. So it just kind of depends on complexity there, but for the most part, you're not going to see huge differences. Processing time is important to get that kind of nailed down up front. It's one thing that I see is kind of missed, is it's just kind of left up to the bank to get that done in the time period that they can. But what I like to see is, what I always ask is, when are you looking to close? What's your time frame? And then I try and map all the due diligence around there. So there's certain things when you start. So let's just do an example. Say you're purchasing a building. There's underwriting that takes place, and there's documentation that I've kind of went over that the bank's going to want. And so you'll get together your finance package, send it over to the bank. They do their underwriting. And that could take, depending on how long it takes you to get together the documents, and the bank has at least a few days to review. There'll probably be some questions back and forth. You may be looking at a couple weeks there. And usually due diligence items are not ordered until after you have kind of a pre-approval. In situations where somebody wants to move very quickly and they believe that they're going to be approved, they may opt to pay for the due diligence items up front and speed that process up. So it's just something to kind of be aware that you can do. Interest rate spread, so it's just kind of looking to see what the rate is, maximum term for financing. So, and that depends on, like I was saying before, what type of financing you're doing. So it's different for everything: equipment, real estate, lines. They're all different. How your loan's set up. You can do interest only in certain situations. Say you're building. That's kind of a common one, or you're doing renovations. Banks can usually set up an interest-only period there. Personal guarantees. So until you get to large corporate banking, banks are almost always asking for a personal guarantee. It's part of the repayment. So banks going to look at how the loan is going to be repaid. Then they're going to look at collateral, and then they look at guarantees. And so those are kind of your top things, and likely won't see anything in kind of the small business or even middle market that isn't asked to be personally guaranteed. Liens on personal residence. So the bank wants to know if they're asking for additional collateral, are they first position, second position, and then how you're going to distribute the funds. So that kind of gets into the logistics of the closing. But just to kind of in closing, I think the overall point that I want to communicate is banks are looking to see that you're prepared, that you've managed credit positively in the past, and that your business plan is kind of sound and realistic. And as long as those things kind of match up, and it shows that you're going to be profitable beyond the loan, so have some room for error there and have enough equity in to where you can kind of weather a storm a little bit, then banks are very willing to move forward. But with that, I mean, I've talked enough. I'll open it up for questions.
Are there any questions out there?
Yes, I have one. Thank you for the information, Gary. It was really useful. There is a minimum credit score that you are looking for, among the potential applicants for a business loan?
That's a great question. We don't have a minimum score per se, because business lending is pretty complex. You have so many different factors, and even in a credit score, a 680 for one person might not be the same as a 720 for somebody else, meaning the 720, they could have, some derogatory marks in the past, but they've moved past it. And the 680, maybe it was just something medical. So there's just so much in and out there. As a general rule of thumb, over 700 is looked at positively, but I can't give you an exact number.
Okay.
And just to kind of further on that, you have your credit score as kind of your first gateway in. As long as that's kind of in an acceptable range, and we keep looking down the line at all of these other things that we've been talking about. Of, is there collateral? Is there, so say you're looking for $100,000 loan, but you have $50,000 in liquidity, and your expenses for your business are relatively low. Well, then that's a pretty easy loan for us to do, and we won't have to rely as heavily on credit score there.
Makes sense. So it's a case by case. I have another question. There is, some lenders got like a kind of 20% down of the dollar amount that you are looking for in order to secure, because they are looking for some skin of you on the game for, to get the loan. So do you have anything like that? Like there is an average that anyone that decide to apply to you guys look like, okay, I have to keep between 20-25% down, to make me a much better candidate to qualify for the loan? There is a minimum 20%, like a 20% or something like that with you?
Yeah, so most banks, it depends on what you're purchasing. So equipment it can be 100% financing all the way up to asking for 25% down. Kind of depends on the situation and the strength of the borrower and the business. But for real estate, it's pretty easy. That one's across the board, usually 20% down. And if it's a little tighter, then banks will ask for a little bit more. They'll ask for 25%. So that's kind of, I don't know if that answers your question.
Yeah, of course. I ask you this because lately we got a lot of requests about people that want to start a food truck. It's like become a kind of popular business idea among a lot of people. They asked me about that kind of information, and I wasn't sure if in this case will be like around 20-25 for that kind of businesses, or are too risky, or how do you think about these kind of businesses?
Yeah, that's a great point. So what you brought up is kind of the difference between an existing business and a startup business.
Yeah.
So if somebody's existing and you have historical cash flows that are strong, then the bank would be much more willing to do, say, a 90-100% financing for them, because they have what you can rely on, cash flows that you can rely on. And say it's like a CNC machine. The resale value on those is very definable. When you move to a food truck, that's a startup business, you kind of lose both of those. It's a marketable asset, but it's harder to define what you could sell that for if you had to. And then the next part is you don't have the reliable cash flows unless they've been doing it for a long time in a different perspective, and you could kind of use that history. So if it's a startup and if it's a little bit harder to define the collateral value, then you're going to look at probably 25% down.
Okay, thank you very much, Eric.
I have a question. Are the rules different for non-for-profits or than for profitable businesses?
The general ideas are the same. There are some differences for non-for-profits. Our bank banks lots of different non-for-profits, and there's, you know, the basics behind lending is still the same. The bank still has to kind of protect itself, but we deal with a lot of different non-for-profits. So it's kind of the same idea as, you know, are the operations profitable? What are you looking for? Yeah, so there's, you know, it's kind of a roundabout way to answer, but there's really not a lot of difference there.
Okay. Thank you.
Yeah.
Okay, any other questions? All right, Eric, thank you so much for joining us. Again, Eric Magnuson, Vice President of Commercial Lending at Illinois Bank and Trust. Thank you so much for being our speaker today. And again, if you have any questions, please contact us, sbdc@rockfordchamber.com or 815-316-4301. Thank you, everybody.
Thank you. Have a good one.
Have a good one.